Hey y'all, this is Mindy Strong, and this is the fourth section helping you prepare for the Series 65 test. We're going to talk about federal securities acts. Here we go. Okay, the Securities Act of 1933 came into effect because there had been a crash. There had been a speculative bubble that was part of the reason for the crash. And so they decided, you know what, we need to regulate these new issues because everybody was speculating as to what was going to happen, and it caused a disaster. Okay, the following applies to non-exempt issues only. The registration statement must be filed before any sales-related activities can take place. The issuer files them. Contains the character of the business, the use of the proceeds, and the financial history. It is signed by the CFO and CEO. Also includes the accountant's opinion and the legal opinion. There is something called a 20-day cooling off period. And during that period, a deficiency letter can be sent if they feel like they need more disclosure. During this period of time, obviously, it can't be sold or advertised. The effective date. So first of all, when something is in the works, you can deliver a preliminary prospectus, but the final prospectus must be sent out prior to or on the day of that registration is effective to each of the customers. Now, U.S. government issues are exempt from this. And here are some exempt issues. Government obligations, issuers regulated under other laws, nonprofit issues, and government municipal issues. Issuers are regulated under other laws and nonprofit issues. I guess I put that twice, didn't I? Well, now you really know the information. Exchange listed securities are exempt under the USA, but not under the federal law. So that's a difference right there. Exchange listed securities are not exempt under federal law. Bankers' acceptance and commercial paper are also exempt under state law, but not here. Okay, so it's the opposite. Intrastate offerings, Rule 147. These are 100% sold to state residents. The issuer must be a resident of the state. And the first 6 months, it can only be sold in the state to in-state residents. And actually, I'm going to talk about this again later, and it's going to look out of place, but that's okay. You'll forgive me. And here are the 3 largest inland area states: California, Texas, and Florida. Regulation D, big D, big dogs, private placements. That's how I remember it, is big D. So these are exempt from registration and prospectus. Think about it like this. We're dealing with the big dogs. You don't have to hold their hand. The max of these private placements, the max can be 35 non-accredited investors, and you can have an unlimited number of accredited investors. They do give a questionnaire. These can be advertised if they're only sold to accredited investors. It provides an offering circular, which is like a prospectus. It's also called an offering memorandum or a private placement memorandum. All mean the same thing. There are no dollar limits on these. There are no state limits on these or the units sold. So again, private placements, the regulation D, as long as you qualify, then you don't have to register, and this is for the big dogs. There are 2 rules under here, Rule 504 and 506. 504 is for the smaller offerings. These are private permitted placement offerings. Try to say that 5 times fast. Up to $10 million. There are no limits on the number of investors for these. They don't require the issuer's financials. They can require state registration. So the big dogs. Rule 506 is for the larger offerings. This is more than 10 million. There is a max of 35 non-accredited investors and unlimited accredited investors. Detailed disclosure is given to investors. It's like a prospectus. The financial statements are audited, and they can't require state registration. So with these 506s, they can't require it. They're more expensive because the financial statements are audited, so you have to pay for that. But both of these are Regulation D rules. 504 is the smaller offerings, 506 is the majority, and those are the larger offerings. Then there's Regulation A for the little ones. This is to help startups avoid a bunch of time and fees. So they're exempt from registration so easier and less money, if they have a maximum of $20 million that they've raised within 12 months and the audited financials are submitted. Now, if they have a maximum of $75 million that's been raised within 12 months, then they're called Reg Plus. They need to also submit audited financials. Simplified offering statement, Form 1A, is filed with the SEC. They have 20 days to review. If there are no problems, then they become qualified. So these are just the people in the startup company, and they are so happy they're exempt from registration because it's expensive to register, and it's a lot of hoops to jump from. So Reg A helps out the little ones. Rule 144. Okay, so let's say you start out as a small company, small company, like a startup, but then you grow. So restricted means these were never registered because they started as they got that, what we just looked at, they got that exception. And Reg A specifically. So now what they can do is small amounts can be sold periodically, no more than 1% a month. They can then register them when they're transferred to the buyer, and they can sell them publicly after holding for at least 6 months. So that is a way to grow from a startup. Very cool. They never registered them, so they're restricted, but using this, small amounts can be sold periodically, and they can just grow right up. Securities Exchange Act of 1934. So 1933 regulated the new issues. 1934 is the regulation in the secondary market. These are the municipalities and federal issuers are exempt, but everybody else in the second market is not. Secondary market. This applies to non-exempt issues again. It keeps abuses from happening. Now, this is a lot. This is our little acronym, MISPERMS. Here we go. Manipulation is fraud. That's a no-no. Insiders can't profit. There's something called treble, which you have to pay 3 times the amount that's lost in damages. The SEC regulates these markets. Short sale rules set rules for selling borrowed shares. You have to locate the shares before you can sell them. Proxy rules. Outside proxies became regulated so they could vote. Exchanges must register. Reports, they need to get public quarterly and annual reports. It's a way to make these companies more trustworthy. Keep abuses from happening. Margins, control over the credit on securities given to the Federal Reserve. The MSRB writes the rules for the municipal market, and stabilization is permitted under the SEC. And then we have 10b-5, which is for future wrongs. Okay? These are all ways that we keep abuses from happening. In 1934, they were like, whoa, 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 whoa. All of these issues, or all of these securities trading in the secondary market, we need some regulation here. Regulators. Corporate and other reporting requirements. Issuers register with the SEC, and they send out 10Q, which are the unaudited quarterly reports. We just talked about those. And 10K, which are the audited reports. These are immediately made available. Sarbanes-Oxley was a rule that was put into place that states that the CEO and the CFO must both sign off on the books and include it with the 10K. That's the audited annual report. 8K must be filed if there's a bankruptcy or change of board of directors, and you only have 4 days to file. They're not messing around there. 13D, I'm going to help you remember this one. They are declaring, person has 5% of the company. They have to report to the SEC. They have 10 business days to do it. And so I have this guy declaring. So 5%, he's declaring he's part of the company. G is for going with the flow. They want to remain passive investor, so they have to file within 45 days. They just want to go with the flow. So there you go. And then there's 13F. These are on fire. The report of holdings, if they hold over $100 million in equity securities, they have to file within 45 days of the quarter ending. So we've got 8K, bankruptcy, file in 4 days, not messing around. You own 5% of a company, you have 10 days, you need to let us know. If you want to go with the flow and be a passive investor, you have 45 days to file. And if you are on fire within 45 days of the quarter ending, if you have more than $100 million in equity securities, we need to know about it. Margin regulations. Regulation of credit was given to the Federal Reserve, and this is what they said. So, Reg T. This controls the credit on securities extended from broker to customer. Broker to customer, and customer has a T in it. So there's our Reg T. Reg U controls credit on securities extended from bank to broker. From bank to broker. Reg U. Initial margin. Initial requirement is 50% stock, so the loan value can only be up to 50%. And then if it's a long-term listed option, then the loan value can be up to 25%. Only exchange-listed securities are marginable. Over-the-counter are not marginable. Over-the-counter are not marginable. New issues are not marginable for 30 days to avoid speculative trading. That makes sense. New issues, 30 days before we have a bunch of speculative trading taking place. MSRB creation, rules for municipal traders, not issuers of munis, just brokers, dealers, and bank dealers. Okay? Brokers, dealers, bank dealers have to abide by these rules. Stabilization of New Issues. Regulation of credit was given to the Federal Reserve, and they wrote, A1 stabilization, say it with me, bid is allowed until the offering is complete. Only one is allowed. It's placed by the manager. It can be placed at or below, but never above the public offering price. Notice of stabilization must appear. So this is to help stabilize the new issues as they come out. But this is very regulated, but it's smart. It's a smart way to get things going. Okay, the Investment Company Act of 1940 requires the registration with the SEC and regulates actions on the federal level. Regulates activities of investment companies. Safeguards are put into place to protect the purchasers of investment company securities. And it limits compensation. That's great. If you break the law, you can have to pay up to $10,000 and up to 5 years in jail. Investment Company Act of 1940. Investment company collects funds from people and purchases securities. They have to diversify the portfolio. There are 3 types of these companies: face amount certificate companies, management companies, and unit investment trust companies. Also, an example of that would be variable annuity. Management company is open-ended mutual funds, only common shares. They're open-ended because they can issue more as money is added. They are non-negotiable shares. They cannot be traded, and they do have 12b1 fees. Closed-end funds, it's a one-time issue. Then they trade, usually in bonds, and they're not redeemable with a sponsor. Management company rules. 100 shareholders, sponsor of a fund registers it with the SEC if there are at least 100 shareholders. Minimum fund capital, the total net assets of $100,000 to start. They want these things to have a little bit of money. Investment advisor is hired to manage with a stated objective. The IA contract has fees, undergoes an annual review. Fully paid security positions. The management companies can't pay securities on margin, but they can borrow from banks. Objective change. If there is an objective change, it requires a majority vote by the board of directors. There are shareholders' rights. They vote for the board of directors. If there's a change in objective or an IA, and they receive annual and semi-annual reports. And another rule is that 40% of the board of directors cannot be affiliated. 12b1 fees. We've talked a lot about them. They help attract new buyers. It's a fee you pay to help attract new buyers. FINRA sets a maximum at 1%, but to be classified as no load, it must be less than 0.25%. Now let's look at the three classes. Class A, remember our long A upfront fee is reduced by breakpoints with minimal annual 12b1 fees. This is best for long-term investing. Upfront, front-loaded. Class B, there's no upfront sales charge, and there's contingent deferred sales charges that eventually decline to zero. The 12b1 fees are about 0.5. And those can turn into Class A once they get to that zero for the contingent deferred sales. Class C, no upfront charges, no contingent deferred sales charge, but 12b1 fees are at about 1% annually. So this is if you want to have a concise investment, a see you later, have a quick investment and get out. So if you're going to do a long-term investment, you're going to look at Class A. Your fees are up front with minimal annual 12b1 fees. Class B, we've got the contingent deferred sales charge, so that's a medium kind of commitment. And then if you want to just get in and get out, see you later with your Class Cs. A diversified fund, we've talked about this before. The definition is 75% or more is invested in securities, 5% or less in one of those issuers, and a max of 10% voting securities in any one issuer. So that's a 75-5-10 rule. Investment Company Act of 1940, again, we've got unit investment trusts. These are set up under a trust indenture instead of a corporation, and it issues shares of benefit interest. There are two main types. The fixed UIT, once it's set up, it never changed. It sets as a fixed unit, obviously low fees. Non-fixed UIT, trust invests in shares of a management company, indirectly buying mutual fund shares with insurance company wrapper, like a variable annuity. The definition of an investment advisor, person who receives compensation for advising on securities. They are paid for advising on securities. That's supposed to be a security. The exclusions, we have gone over this. Banks or bank holding companies, professionals like lawyers, accountants, teachers, anyone who has an incidental connection, broker-dealer whose performance is incidental, publishers of newspapers or newsletters who give advice in general, any person who advises about government guaranteed obligations, and family offices. Family office rule. You can only advise members of the family. Up to 10 generations, adopted and divorced, are included, and They allow for key employees of the office, estates, and trusts. Must be wholly owned by the family, can't be owned by the employees. Intrastate exemption only does business in one state. They don't have to register federally, but then remember the rule of 147. They can't resell anything out of state for 6 months. Sophisticated. You don't have to register federally if you only work with insurance companies. Registration with the SEC. Okay. If you have over $1 million of assets, advisors to investment companies, 90 million to 110 million is that buffer range. Or if you're mid-size, you have 25 million, you're not required to register in the state. You must register with the SEC. If you have 15 or more states, then you can register with the SEC instead. That's, again, for the mid companies. Private fund advisors with over 150 million must register with the SEC, and less must register with the state. Qualified purchaser is an individual or trust with at least 5 million in assets. An accredited investor has at least 200,000 invested, 300,000 if it's a couple, and $1 million net assets. No registration of the investment advisor reps. The investment advisor must fill out a Form ADV Part 1, name and info, and states any statutory disqualifications. Form ADV has a lot. There's a brochure requirement in 2A, which has business contact, material changes in the past year, description of business, fee disclosures, prepaid fee disclosure, other compensation disclosure, performance fee disclosure, minimum balance, methods of analysis and investment strategies, legal issues, relationships with other financial institutions, sub-advisors used, code of ethics, financial interest in securities. How do you select the broker? Soft dollar, client referral compensation, discretionary authority, proxy voting, impaired financial condition. Form ADV Part 2B. This is the brochure supplement. It's the information about the key people who work at the firm. Education and background, professional designations, any discipline against a supervisor, any outside business activities. How does the advisor monitor everything? Registration within 45 days for this. The PF form, which is the private fund form used for private fund advisor registration. You must still register the form's ADV, even if you have less than 150 million. Promptly means within 30 days. ADV update has to be done within 90 days of the fiscal year end. An ADVW is a withdrawal that must be documented within 60 days. And in the state, they give you 30. The brochure rule, we already went over this, but Form ADV Part 2A is the investor brochure. It's the summary of changes that must be delivered within 120 days. Prompt delivery of changes due to disciplinary action. Form ADV Part 2B is the brochure supplement. Both must be delivered at or prior to entering into an advisory agreement signed and dated. Both. Record keeping. Basic records to be kept. Cash receipts and disbursement ledger. Order ticket copies. The name of the person recommending, the name of the executing broker-dealer, the customer account, copies of all communications sent from the IA, copies of all advertising to 10 or more people, copy of signed disclosure statement. Records kept if custody is taken. Basic records to be kept. Securities received, securities record, confirmation copies of all customer trades, customer account statements showing all purchases, sales, securities, positions, and cash debits. And these need to be kept for 5 years. We know this, but here we go again. Broker engages in business of effecting transactions for the account of others. Market mailer. Market maker, also known as the dealer, engages in business of effecting transactions for his or her own account. Broker-dealer either engages in the business of effecting transactions for his or her own account or for others. Agent represents a broker-dealer. Investment advisor contracts. You can't be compensated based on capital gains. There's no reduction if the fee is based on poor performance. You can't assign the contract to another investor without permission. You can't include exemptions from liability for poor performance. And you have to notify if there's a change in partnership. Performance fees. You can have performance fees if you're working with someone whose net worth is at least $2.2 million and they have at least $1.1 million under management. There's a fulcrum fee. It's the basic fee charged by the investment advisor, and then there's the performance fee, which is what we're talking about based on the comparative performance to specified index. And there's a hedge fund rule there. Custody of clients' funds. If you take custody of the client's funds, you must segregate the customer funds from their own. Hold with a qualified custodian. The IA is the trustee. You have to notify the customer of the qualified custodian's name, address, and manner. That should be manner in which it's maintained. And you have to quarterly send itemized account statement. Must have an independent review on Form ADVE within 120 days. That is the end of this section. That is a lot, but it's a lot because it's going to be a lot of the test. That's the Federal Act section. Go back over this. This hopefully is helpful to you guys. Have a great night, day, evening, afternoon, early morning, and let me know what you think about this. Thanks.